Congrats! You've made it to the intersection of why didn't I learn this earlier and I was today years old. Here, we'll explore some of the basics of the topics we wish we knew more about before today. We'll look at finance, technology, hacks, and things we could use the why of. Today, I wish they taught us about stocks. What are stocks? Stocks are one of the most popular ways people invest and build wealth. But what exactly are they? In simple terms, a stock represents ownership in a company. When you own a stock, you own a small part or a share of that company. What does it mean to own a stock? Imagine a company like a big pizza. The pizza is divided into slices. Each slice is a share. When you buy a share, you own a slice of the company. As an owner, you may get two main benefits: dividends, which are a portion of the company's profits paid to shareholders, and capital gains, meaning if the stock price rises, you can sell it later for a profit. But you also share risks. If the company does poorly, the value of your stock can drop. Why do companies sell stocks? Companies issue stocks for fundraising. Instead of borrowing money and paying interest like a loan, they sell pieces of ownership to investors. This allows companies to expand operations, develop new products, pay off debts, and hire more employees. In return, investors hope the company succeeds, making their shares more valuable. How are stocks traded? Stocks are bought and sold or traded on stock exchanges like the New York Stock Exchange, NASDAQ, or the London Stock Exchange. You can't buy stocks directly. You need a broker or trading platform. When you buy a stock, you become a partial owner. When you sell a stock, you transfer ownership. Stock prices change constantly based on company performance, economic conditions, and market sentiment. That is what people believe will happen. Types of stocks. Not all stocks are the same. Here are the main types. Common stock. Most stocks are common. Owners have voting rights and may receive dividends. Preferred stock owners get fixed dividends first, but usually don't have voting rights. Growth stocks. Companies expected to grow quickly usually don't pay dividends. Value stocks. Stocks priced lower than what they are worth, often with solid dividends. Blue chip stocks. Stocks of large, well-established companies like Apple or Coca-Cola. How are stock prices determined? The price of a stock is mainly based on supply and demand. More buyers than sellers, price goes up. More sellers than buyers, price goes down. Other factors include company earnings reports, news events, economic indicators like unemployment or inflation, and interest rates. For example, if Apple announces a breakthrough product, many investors might rush to buy its stock, pushing the price up. Why do people invest in stocks? There is potential for high returns. Historically, stocks have outperformed bonds, savings accounts, and other assets over long periods. Dividends. Some companies pay you a share of their profits regularly. Liquidity stocks can usually be bought or sold easily compared to other investments like real estate. Ownership. You own a piece of big companies and can benefit from their success. Risks of investing in stocks. Volatility. Prices can rise and fall quickly. Market crashes. Entire markets can drop suddenly, like in 2008. Company-specific risk. Bad decisions, scandals, or competition can hurt a company's stock. Golden rule: never invest money in stocks that you can't afford to lose. Long-term strategy: how to use stocks wisely. Diversify: don't put all your money in one stock. Spread it across industries. Think long-term. Historically, holding stocks for years, not days, has led to the best results. Stay calm, ignore short-term news. Focus on strong companies. Learn first. Understand what you're buying. Don't just follow trends. Conclusion: stocks are a powerful tool for building wealth, but they come with risks. By understanding what stocks are, how they work, and how to manage risk wisely, you can become a smart investor. Stocks mean ownership. Prices equal supply plus demand. Smart investing equals diversification and patience. Bonus: quick terms glossary. Dividend: profit paid to shareholders. Shareholder: someone who owns stock. IPO, or initial public offering, when a company sells stock to the public for the first time. Portfolio: your collection of investments. Broker: a service that helps you buy or sell stocks. If you have any questions or suggestions for future topics, please comment below. If you enjoyed today's video, please like and subscribe.